If you've been considering either a first or further UK property investment, you've likely been weighing up if now is the right time to dive in. Welcome to our latest episode of the Harbour Property Group podcast. I'm Chris Thompson, and today we'll delve into the current state of the UK property market, explore some of the key concerns and considerations when it comes to market timing, and hopefully answer the burning question, is now a good time to invest? To help us answer these questions, I've been joined today by Elliott Babbs from API Global. Between us, we have an episode packed with practical advice, exclusive insights, and actionable strategies to guide you on your investment path. Hello, Elliott. Thanks for coming on to talk to us today. So, first of all, if you wouldn't mind telling us a little bit about you and maybe a little about your property experience.
Yeah, cheers, Chris. Thank you for the introduction and thank you for having me on. So, my name's Elliott Babbs. I think, look, first and foremost is I am a property investor. I've been investing for the last 10 years now. Bought my first investment property at the age of 23, which certainly brings its own challenges, but a lot of excitement along the way. You know, I live and breathe property. It's where I've built, my wealth and my income. And alongside that, I also represent a company called API Global, and we're here to help people anywhere in the world invest in UK property. It's one of the most stable markets, secure markets, and I think also one of the most open markets. You know, realistically, you can invest from pretty much any country, any corner of the world, and the UK market welcomes you with open arms. It needs to be done in the right way, but that's what I do.
Thank you very much. Well, thanks for that, Elliott. It's clearly the man for the job. So let's dive in, shall we? First question for you. We speak to obviously a large number of both first-time investors and also those looking to grow their existing portfolios on a daily and weekly basis. And the same three things seem to come up again and again: interest rates, property values, and changes to property law and legislation. So let's take interest rates first of all. In recent years, we've seen a steady climb to current Bank of England base rate at 5.25%. And obviously that's mainly being driven by inflation, which thankfully seems to be running out of steam. So the first question then, what's your view on what's going to happen with rates in the coming months and years, and what impact do you think that will have on the property market itself?
Yeah, absolutely. I mean, look, first of all, I think the decision from the Bank of England to not reduce the interest rates this time around, I think whilst a lot of people were expecting it and maybe hoping for that to happen, I think it was probably a sensible move. What we don't want to happen is that those interest rates start to decrease too quickly, too rapidly, and then we see a bounce back because things have happened too quickly. So whilst we need to be a little bit patient, I think it's a positive step. The fact that it's maintained the same rate for, I think it's the last 4 or 5 MPC meetings now. Yeah. I think that most people are expecting, it's no secret that rate will drop over the course of the year and probably over the course of 2025 as well. Look, you got to look at the clues, Chris. You see the signs, and one of those are mortgage rates. Whilst the base rate didn't actually reduce this time around, you still saw that mortgage rates did reduce. And obviously those big banks, not saying they necessarily have inside information, but they can certainly see what's going to be happening in the future. In terms of what will then happen to property prices, I mean, look, as interest rates reduce, people's mortgages reduce, monthly payments reduce, that stimulates growth in the market. You do tend to see that property prices will increase based on that, because there's just more confidence and positivity in the market. This year, there was a lot of negativity around it, and we did see the base rates, increase, as you rightly said, at a steady pace. Things never were as bad as people were maybe anticipating. The market actually stayed fairly flat this year. Which is probably, in the 10 years I've been investing, the most negativity I've seen in the property market. Yeah, it held strong, it held tough, and I think we're over the worst of it now and got a positive year ahead of us.
Yeah, fantastic. Thank you. So we're going to come on to in a little more detail later on, but there are alternative options to locking in those higher mortgage rates. But if you
Yep.
just want to get on with it, there's as many of our clients do, it's worth taking some advice on how best to approach your borrowing. So question
Yep.
two then. What are your thoughts on the best lending strategy at present? Should we be looking at long-term fixed to lock in those lower rates, a variable or tracker to back ourselves with the view of that falling rate that you mentioned, or maybe even a larger deposit or cash purchase to dilute the impact? What's your view?
Yeah, good question. So I think it comes down to your risk appetite personally. If you are investing in a deal that you can see the rental income's going to support the monthly payments, even if they're potentially higher than they will be in 6, 12, 18 months time, if that is what makes you feel comfortable and you then have no risk of your mortgage payments increasing and you're a bit more risk averse, then I would say let's have a look at the fixed rate mortgages. If you are someone that has a greater appetite for risk and predicts that mortgage rates will reduce over the upcoming years, then something like a tracker is a good move because it's going to be a certain percentage above the base rate, and as soon as that base rate reduces, then your mortgage payments reduce. So look, that's the beauty of property, Chris, is that you can look at very volatile, high risk, high return strategies. You can look at something that's very steady, solid, and secure. And it comes down to what you're looking to achieve and what your end goal is, really. So I think the answer to that is it depends. Is that fair to say?
Yeah, I think so. Yeah, absolutely. Everyone's individual circumstances, but yeah, no, some good insight though, nonetheless. Thank you very much. Okay, so we put a lot of weight, and understandably so, on interest rates and the impact they'll have on net yields. But just how
Yeah.
damaging can a higher rate be to our overall long-term investment performance? If we decide to take the plunge now, let's say, despite these
Yeah.
higher rates, what can we expect in terms of a net outcome then?
Yeah, absolutely. Well, actually, just on a slight side topic there, I mean, you're just talking about taking the plunge now, Chris. I mean, I think for property investors, it's such an important thing to kind of get into our heads. There's always a reason why we shouldn't invest in property, but the reality is there's more reasons why we should. Going back to my example, at the age of 23, I could have easily said, it's too early. Let's focus on a corporate career. Let's do this. Let's do that. But the reality is that the earlier I got in and the quicker I did it, the better the results and the greater the results. So there will be a lot of things that crop up along the way: legislation changes, rules, regulations. Interest rate is just one of those things. What I would say is that when we're looking at deals, we do want to analyze and we want to make sure that the deal stacks up. For me at the moment, a deal stacking up is making sure that we're at least cost neutral. Some investors might look at it and be happy to lose or pay £200, £300 a month because of the capital growth that they're going to get. And I completely get that because, look, the capital growth is going to outweigh those payments that they're going to make. But for me, I still think that you don't necessarily want to do a deal that costs you money every single month. Because also it's about building your portfolio. You might look at it and run some financial analysis and think, well, I can afford that £200, £300 a month, but the likes of yourself, Chris, I know you're here to help people build their portfolios. The first property is just the first step. So what about the second one, the third one, the fourth one? All of a sudden, if that portfolio is costing you £1,000, £1,500 a month, you start to feel the strain. So for me, a deal that is at least cost neutral, if it's making you money every single month, that's a benefit. And making sure that you're investing in areas that have long-term capital growth, that's always going to far outweigh the income that it's going to generate anyway.
Yeah, great point. Okay, great. So given the majority of commentators are suggesting a decline in Bank of England base rates in the short to medium term, some investors are choosing to delay investments until more favourable rates come through. I guess the problem there is that those that have got cash savings on deposit will be experiencing erosion of their capital due to inflation. So many investors are looking to off-plan property that may not be quite ready or even a couple of years away from completion in order to sit out that period of higher interest rates. So what's your view on off-plan property, and is it a good strategy to delay the necessity for borrowing?
Yeah, 100%. It's a great way of alleviating these higher interest rates that we're facing at the moment. I think also the thought process of, maybe we sit and wait for interest rates to drop. As we just discussed, one of the things that you'll find is as the interest rate drops and the market improves, property prices will go up. So you're kind of always chasing this. The longer you wait, the higher the property value becomes, and actually the more that you have to pay in the long run. So it's really important that we find strategies to just keep moving and keep that momentum. Off-plan's a great strategy for those that are focused on capital growth. If you're here and you need income now, then we certainly look at completed property. But the benefit of off-plan, as well as obviously avoiding the higher interest rates, kind of delaying that need for a mortgage, but also you're going to get more aggressive growth on an off-plan property, because not only is the value of the land and the value of the area going up over a period of time, naturally developers, they will incentivize people to get into developments early. So the earlier you get into that development, you get in it at launch price or those early rates, and you'll see the cost of those sale prices increase throughout the build as well. So you're kind of winning on both sides. You've got the natural growth of the area, but then also the growth as you get closer to completion. But you're absolutely right. From an avoiding high interest mortgages, that's certainly a good way to go. And I mean, from your experience, Chris, would you say that more people are leaning towards that in the current market?
Yeah, I'd say there's more off-plan purchases going through us at the moment than anything else. Some odd things happening in the market. Lots of increased interest in London, lots of increased interest in plan, and so on. And I think another point with off-plan is it's got this bit of a reputation for itself, hasn't it, over the years? And certainly. If you speak to clients in China at the moment and speak to clients in Dubai, they've all got these horror stories about off-plan and things going wrong and so on. But it's just simply not the case anymore in the UK, is it? Whenever you look up in these areas of high development, high regeneration, the cranes are all moving. There's you haven't got that same threat of failed or delayed developments, which is refreshing, and all credit to the UK government that put legislation in place that's made that happen.
Absolutely. I mean, look, you still have to have a level of due diligence, but in terms of the risk level, the UK versus the rest of the world, it's chalk and cheese. But you're absolutely right. A couple of tips that I would give: obviously, do your due diligence. We only work with developers whose projects are fully funded. Okay, so they're not reliant on sales of units in order to fund the rest of the build. That's when it becomes a bit of a house of cards, and all of a sudden sales don't go through and things start to slow down. Again, working with developers that have got a proven track record in areas of the country where we've seen the growth and we've seen the performance. So you're absolutely right. The risk is much lower. Some developers now as well have 100% deposit protection, which is very, very new to the market. But something where effectively the whole deposit is fully protected removes the risk from off plan. Things like long stop dates as well. So if the project isn't completed by a certain time, the client is able to get their capital and their investment back. Again, that isn't around on every single development, but these are the kind of things that you want to do. The whole thing about properties is risk mitigation. How do I make as much money as possible for as little risk as possible? And that's how you win it.
Yeah, absolutely. Thank you for that. So I suppose brings us on to the next point. We're talking a bit about off-plan property proving useful at the moment because of interest rates and so on. But it's always been pretty popular, isn't it? So there's always been an appetite for off-plan, however increased it is at the moment. So
Yeah.
What are the other benefits to purchasing off plan then? So when cast your mind back to when rates were at their lower levels, we were still
Yeah.
working with off plan. So why is that? What are the other benefits?
I think, look, the growth is the big one, really. If during the cost of that build, or during the time of that build, you're getting much more significant growth than buying something that's already complete. When you're buying it complete, you're paying a premium for that product being ready and ready to hand over. So that's certainly a big one. I think also from a client's perspective, it's slightly easier to get into an off-plan deal because you're then splitting it into two parts, which breaks it down. A lot of people that we work with, I know yourself as well, Chris, are busy, they're in jobs, they're working, they don't want to spend a lot of time and energy and effort on investing, which is obviously where, companies like yourself come in. But then if you've got off-plan property, you've got two parts. So you're securing the unit and you're getting to the point of exchange of contracts. So you are then legally entitled to buy that unit. That unit cannot be sold elsewhere. So there's a bit of legal work to get to that point, and then the contracts to sign. And then actually you don't need to do anything until the completion of the property or close to the completion. That's when the mortgage company comes in and starts to help you with the right access to lending. The letting agent comes in and helps find a tenant. So I just think for clients that are busy and don't live and breathe property necessarily, it just breaks it down into bite-sized chunks. Because I'm sure you probably agree, Chris, for some people property can be a bit overwhelming. People have normally been thinking about property for a long time, but they haven't got started, and sometimes it's just a bit of overwhelm or not knowing where to start.
Yeah, totally agree. It's one of the obvious places to go at the moment, isn't it? Property gives you that security, gives you that reassurance. Whilst all else is sort of a little bit more volatile. The one thing that holds people back from doing it is the complexity of property investment, which, as you say, can be quite overwhelming if you haven't got the right guidance in place. So,
Yeah.
Great. So we've covered quite a bit of ground there, I think, on interest rates, and certainly some useful tips on how to overcome them. But what about property prices? So we've seen some marginal corrections in property prices in recent times as the cost of borrowings naturally
Yeah.
the market. I guess the big question is what happens next? Are we to see further declines, or are property prices on the move again? What do you think will happen with property prices, let's say, in the coming months or years?
I think, look, with property, it's always important to focus on the long-term strategy. What I personally don't believe property is, it's not trading. It's not trying to buy at the very bottom of the market, wait for the market to hit the top in 6 months and sell it. It's a long-term hold strategy. So could there be a dip in property prices over the next 6 months? Personally, I don't think so, because as I mentioned before, I think we're probably over the worst of it now. Again, with the base rates, staying still, probably going in the right direction in the upcoming months. We're well beyond the pandemic now. All of these things that if there was going to be a property crash or a decline in property prices, you could argue that we should have seen that in the last couple of years, and we haven't really. So I do think that property prices will stay solid for the next 3 to 6 months, and we'll start to see an increase over the next 12 months. But what I would say is it doesn't matter. And I know that sounds a bit of a flippant comment, but my existing portfolio at the moment, if property prices went down over the next 6 months and the portfolio is worth £250,000 less on paper, well, it's all tenanted, it's all rented, it's all generating an income. So I just don't sell when those prices are down. I'll hold those properties, and my personal strategy is to hold them for as long as physically possible. So I think, look, reality is with property is we can guess and we can look at what's going to happen in the market, but actually, as long as we are in this for the long-term play, and I'd say 3 years probably as a minimum, then it's going to be in the right direction. You look in the UK, and this is where different parts of the world are very different, peaks and troughs. The UK, You go back 10 years, property prices were less. You go back 10 years before that, property prices were less. You go back 10 years before that. As long as you're holding it long enough, it's a fairly safe bet.
Yeah, absolutely. I mean,
sorry, I went on a bit of a tangent there, but I think it's one, right? It's thinking about what that strategy is, and it's a longer term play.
Yeah, absolutely. What's been interesting during this period of marginal decline, this small dip that we've seen, is that many of the investment locations we, and I know you guys at API have been talking about in recent years, have fared probably better than maybe most of those other areas that have maybe benefited from development, investment, regeneration, that sort of thing. I mean, that's great news because it obviously means that the research and the strategy that we've taken has been successful. So I'd be interested, what areas are you seeing as favourable at the moment? Where are the investment hotspots in your view?
Yeah, okay. So I would say that, look, the big cities, your main tier one cities in the UK are always very solid. What I would say, and one of the things that we do with our market research is, let's use Manchester as an example. Manchester's a great city, great investment area. There's a lot of areas that have had regeneration, they've had a lot of development, and as a result, you've seen those prices increase. Now, it's not to say that those areas shouldn't be invested in anymore, but what you would say is that kind of exponential growth has probably gone in those areas, and then you're going to start to see that kind of steady, consistent growth. So we're always focusing on where are the areas for that exponential growth. One of the things that we do, we'll look at the inner city ring road of your major cities, your Birminghams, your Manchesters, and we'll try and find the pockets that haven't been fully regenerated, don't have, the coffee shops where you pay £5 for a coffee and, £5 for a croissant as well. All of these little independent shops, all of those places that haven't had them kind of come into the area yet. And that's where you'll see the growth. So yes, we're focused on the developer, the quality of the development, the quality of the contractor who's completing that development. But what's happening in the area around it? Are there new university campuses, as an example? Is there a huge amount of government funding that's been pledged to the area? Are big corporate companies coming in? I mean, Derby's a great example of that. Derby, going back a few years, people would not have considered as a solid investment area. They probably might have turned their nose up a little bit to it. All of a sudden, the likes of Rolls-Royce are bringing in an office and a factory with 12,000 members of staff into the city. In a small city like Derby, that's huge numbers. Yep. Derby also, this is quite an interesting fact, has got the highest graduate salary outside of London. Right. Derby. So, it's all of these little things accumulated together creates that investment case, So, yeah, I would say that the big cities, your tier ones and your tier two cities, you want to stick in and around, and then it's about finding the right spots within those cities, which is really what we focus on all the time.
Great. Thank you very much. Being independent, I suppose, at Harbour, we're not supposed to have preferred properties or developments, but sometimes you just get one of those developments that just capture your attention, and they just make sense. They got that wow factor, whatever it may be. So, have you got a favourite? What's your favourite development at the moment, or will you get in trouble for sharing?
I don't know if I will get in trouble, but I'm going to tell you anyway. So, the one behind me, actually, on the wallpaper. So, the W residence in Manchester, I think, as a launch, has just been one of the coolest launches that I've ever been involved in. Obviously, Salboy, one of the biggest developers in Manchester, personally backed, the deposit's personally backed by the owner, Fred Doan, who's got a $2 billion family office. So from a safety and security perspective, Gary Neville is their joint venture partner. So there's been a lot of interest, from the media because of that. There's been a lot of footballers. I definitely can't give you the names of those people, but, a lot of footballers, a lot of high net worths, A lot of famous people have been investing into this development. W branded residences, you could argue one of the coolest hotel brands in the world. We did a launch event in Dubai at the W Hotel. It's just one of those projects where people just get it. It ticks all of the boxes from the luxury market and the luxury perspective. And Manchester is ready for that. It's experienced that with the Hilton in Deansgate. So this isn't the first branded residence in Manchester, but it's certainly the best, arguably the best branded residence in Manchester. And the market's ready for it because it's experienced it before. It's pushed price per square foot, through the roof in the city. And I think it will continue to do so. And Manchester as a whole, all of the developments that, we support within Manchester have benefited from this project. I know you've been involved in it as well, Chris. It's just an awesome project, right?
Absolutely stunning. Yeah, absolutely stunning, and just genius. It's a great addition. What if clients wanted to get involved? I believe there's still availability. Yep. Well, there is still availability on the 2 beds at least.
Yeah.
So what's a typical purchase plan look like? How does a client come to market with something like W?
Yeah, absolutely. So it's about 80% sold. About 20% of the units are still remaining. And actually, it's interesting you ask about the payment plans, because this is one of the reasons why, again, I think the off-plan model in the UK is far superior to that, particularly in the Middle East, where you find that during the course of the build, you'll pay around 60 to 70%, sometimes even more, actually, 80% of that property value. Whereas in the UK, well, the W as an example, is 15% on exchange. You pay another 10% within 6 months, and then there's nothing to pay until completion. Now, the real benefit of that isn't just delaying the fact that you need to invest the remaining 75%, but obviously once the project's complete, that can be purchased with a mortgage. So you're investing 25% on the W in Manchester, whereas you look at a lot of the projects in the Middle East as an example, you need 60 to 70% of the total property value in order to get in, and that prices a lot of people out. So for me, that's one of the huge benefits. And obviously, the less money you put into the deal, the better your return on investment, because all of that growth that happens during the course of the build, that's yours, but you've only put a quarter of the amount in, as opposed to putting in 3/4 of the amount. So it just changes the game with your return on investment as well.
Yeah.
But yeah, sorry, I could talk about the W for hours, but it's an awesome project.
Yeah, absolutely. And what will come with the purchase? So something like W, what would a client expect?
Yep. Yeah, so with the W and with a lot of our projects, actually, I would say that everything from a fixtures and fittings perspective, your fitted wardrobes, your appliances, so your built-in ovens, your washing machines, your fridge freezers, your dishwashers, that would all be included as standard. Soft furnishings aren't included, and what I would say is the W is probably a good example where bringing that wow factor, something fully furnished, is going to attract really the premier rents in the city. But then there's some developments where you could argue that it's better to provide that property unfurnished. Now, what happens when a tenant moves in and it's unfurnished and they bring their furniture in? Yeah. They stay a lot longer because that moving in process has been a bit more of a headache, and they're subconsciously setting themselves up for a longer period of time. So furniture is a case-by-case basis. Certain projects we would recommend it, certain ones we wouldn't, but we'll always make sure that your appliances are included, because otherwise costs can get out of control then.
Yeah, good stuff. Okay, so on to the final hot topic then.
Okay.
How desirable UK property remains with investors. So we hear a lot of hear a lot about changes to legislation, tax treatment, etc. for buy-to-let investors and landlords. Just wonder what your thoughts were on how advantageous UK property investment still is.
Yeah, I mean, look, what I would say is when it comes to legislation, there will always be new legislation. There will always be changes in the market. And that's where I think people sometimes get stuck, where they're waiting for all of their ducks to be in a row, for everything to be absolutely perfect. You know, look, with investing, there's always challenges. When I first started investing, so sub 25, there's a lot of mortgage lenders that won't lend to you. I wasn't aware of that at the time. So I had to navigate my way, work with a good broker to get the right mortgage. During that period of time, you've had Brexit. You know, there was a lot of negativity saying, you know, the buy-to-let market's going to be gone. All of these people that are European are going to, you know, mass exit the country, and there's going to be no one left to rent property. It's just not been the case. We've seen a greater demand for rental properties. We've seen increases in rental prices. You've had the pandemic. Again, you would argue that people were expecting huge issues. What happened? Well, people spent more time at home. So actually they went looking for more premium property. Again, rental prices increased. So don't be afraid of legislation. Don't be afraid of change, because it will happen. From a tax perspective, there's a lot of structures now that allow your business to be very tax efficient. And property, without going too far down a tax rabbit hole, property is a very tax deductible business. You know, there's a lot of things that you need in your property business that can be legitimately, deducted against your profits. One of the other things as well is that if you're looking to build a portfolio, which is something that I'm very passionate about, I know you are as well, Chris. It's not about one property for someone. It's how does someone build a portfolio so that they can retire younger, pass it down to their children, their loved ones, you know, whatever it is, and whatever that reason for investing in property is. When you're looking at remortgaging property, when you refinance that money, it's gone up in value, you pull that money out into your business, you are not paying any tax on that money. Yeah, so if you pull out £100,000 from your property, you're not paying any tax on that, because you're refinancing by way of mortgage. A mortgage is a loan, and there's no tax to pay on a loan. You pull that money out, and then you utilize that to reinvest. So it really can snowball, and I think that's, for those, you know, going back to the point about being willing to do this over a period of years, you really can see your portfolio be tax efficient. You can see it be self-sufficient and kind of subsidize the next investment. I'm sure you've seen that, Chris, working with people for, you know, a period of time, people coming back and go, right, this has gone up in value. I'm ready to buy the next one. I'm ready to buy the next one.
Yeah, absolutely. It becomes quite addictive, I think.
It does. It does.
Well, you know, if you get into the market, you know, a first-time buyer or first-time investment property buyer, and they get an easy run, and you know, there's no problems, and the complexities removed, and why would you not? You know, secure investment that the returns are, you know, way over and above what you'd expect from a secure asset. It's you know, the obvious way to go to do number 2, 3, and you know, after you get to the sort of tipping point is, you know, where it really starts to pick up a bit of momentum is after property 4, where, you know, all of a sudden you've got, you know, the leverage capability of, you know, a small portfolio of properties, those 4 properties, and the income that's coming from them is making everything easier. And all of a sudden you find yourself in that spot where you're on to number 7, number 8, and onwards.
Yeah, just continue to snowball. It's kind of the bigger it goes, the quicker it will run. But it's just getting that first deal done. I think that's the stumbling point for a lot of people. I've spoken to so many people over the years that you could say that most people you speak to have wanted to do property. You know, very few people say, I don't want to invest in property, I don't like property. Most people do, but there's normally a reason why they have or why they haven't, and it's just, I guess, our role is to help people kind of unlock that potential and, you know, overcome those hurdles that they may be facing. Can I get a mortgage? It's one that I get asked a lot. More often than not, the answer is yes. You know, can I do it remotely? I spend most of my time overseas now. I haven't stepped in one of my investment properties in probably 5 or 6 years because, they're self-sufficient. You've got the right team around them. They're being managed. That's not my responsibility to go and change the light bulb or fix the tap. That's why you have the people around. So, yeah, look, there's a lot of things that stop people from physically doing it, but the quicker you get on with it, the quicker you see the results from it.
Absolutely. Secret to getting done is getting started.
Absolutely. Yeah.
Okay, so there we have it. We've explored the state of the UK investment property market, covered off some of the key considerations when investing, and hopefully helped you answer the question, is now a good time to invest? So remember that the decision ultimately depends on your individual circumstances and goals, but with the insights we've shared with you today, hopefully you'll be better equipped to make a more informed choice. For more information, please visit our website at www.harbourproperty.group for more resources and to book a free consultation with our investment team. And please don't forget to subscribe and share this episode with anyone interested in the UK property market. So, Elliott, just want to say a massive thank you to you. It's been an insight. So thank you very much. Is there anything you wanted to say before you go?
No, awesome, Chris. Thanks for having me on. And look, the more people that invest in a country and a market that needs good quality housing, because we've spoken about it from a financial perspective, but from an ethical perspective as well, the more good quality accommodation that we can provide from a country that is in a chronic undersupply, then the better as well.
Brilliant. Thank you very much. And bye from me.